Let's get an update on the business news now. Yuka Roy is with us here on set. Yuka, starting with that big story of the year, big story of the day as well. US-China trade war. Latest round of tit-for-tat tariffs has kicked into effect a couple of hours ago now, hasn't it?
The new tariffs from both sides went into effect earlier this morning. The US has imposed 10% tariffs on $200 billion worth of Chinese imports that will increase to 25% in January. And Beijing retaliated by putting import duties on $60 billion worth of US products. The latest round comes on top of tariffs on $50 billion worth of each other's goods earlier this year. No date has been set for new trade talks between the two, as China called off a visit by Vice Premier Liu He to Washington this week. US Secretary of State Mike Pompeo said on Sunday the US wouldn't back down.
The trade war by China against the United States has been going on for years. Here's what's different in this administration. To the extent one wants to call this a trade war, we are determined to win it.
Mike Pompeo there. What about the markets then, Yuka? How are they reacting to the latest?
Well, those new tariffs were expected, but China's refusal to meet US officials for talks still spooked investors. Shares in Hong Kong dropped more than 1% this morning, and the other major markets in Asia were closed for a holiday Monday, as you can see there. And here in Europe, markets opened in negative territory as well. In London, the price of Sky is up more than 8.5% after US cable giant Comcast outbid 21st Century Fox and is poised to buy the British pay TV. Turning now to some more of our business headlines at this hour. And French supermarket chain Casino says it has been approached by its larger rival Carrefour for a possible tie-up, but that its board has rejected the proposal. Carrefour, however, denies having made such a move. Casino's stock price has fallen by almost a third this year amid disappointing revenue and its handling of debt. It also faced a credit rating downgrade earlier this month. Canada's Barrick Gold is set to merge with its British rival Randgold Resources, according to the Financial Times. The deal would create the world's biggest gold miner, producing more than 6.5 million ounces a year. Under the deal, Barrick's shareholders will own 64% of the merged company. The news comes as the price of gold has suffered a 9% decline over the past year due to a stronger dollar. Singapore's competition watchdog has fined ride-hailing firms Uber and Grab a total of around $10 million over their merger deal, which it said created unfair competition. The authority also ordered Grab to remove its exclusivity arrangements with drivers. Uber sold its Southeast Asian business to Grab in March in exchange for a stake in the Singapore-based company.
Not much French news on the programme today, so let's put that right with one in the business. It's a big day, in fact, in the economic and political calendar here in France. The government is set to unveil its budget proposal for next year. This is at a cabinet meeting later this morning.
That's right. The 2019 budget plans have proven to be a difficult one to handle for Emmanuel Macron's government amid a slowing down in France's growth. One goal high on their list is boosting people's purchasing power. The budget plans include €6 billion worth of tax cuts, while also trying to keep deficit in check. Brian Quinn reports.
A delicate balancing act in a diminished economic climate. The presentation of France's 2019 budget comes as this year's projected economic growth has been revised downward from 1.9 to 1.7%. The budget deficit deepening from earlier forecasts of 2.3% now to 2.8% of GDP, with the EU's deficit limit of 3% looming in the minds of policymakers. Amid the context, a host of reforms. President Macron's promise to do away with the housing tax for some 80% of households still on the table. Another campaign pledge, a hiring tax credit for businesses, will be transformed into a lowering of their social charges at a cost to the state of some €40 billion. By September of next year, workers should no longer have to pay social charges on overtime hours, and in the interest of simplifying the code, 22 taxes are due to be axed altogether, costing the state around €200 million. A government program to incentivize the phase-out of polluting diesel vehicles is scheduled to reach €570 million in 2019, an increase of €180 million. To offset lost revenue and slowing growth, some belt-tightening on the menu as well. Pensioners, recipients of housing benefits, and beneficiaries of family allowances will see their benefits de-indexed from inflation, rising only 0.3% in an effective cut to their purchasing power. Public sector jobs also on the chopping block, with roughly 4,500 due to be cut next year, some 50,000 by the end of Macron's first term.
And that wraps up our business segment.
Thank you very much, Yuka. Yuka with the business on France 24.